Hello and welcome back to the Week in Markets from True Potential. It's Friday the 19th of April. I'm joined today by George Bell, one of our portfolio managers, to review the key economic and market events from the past week. Firstly, I wanted to build on some of the comments that were made when we were looking back at our review of the first quarter, and particularly bringing everybody up to date with what's happened in April. And I think our colleague Paul Durrans described it as a bumpiness to start to the month of April, and that's certainly continued this week, very much driven by geopolitics and the events in Iran and Israel over the weekend, and again also overnight. I think it's very hard for us as portfolio managers to provide a context or review on that, so we're going to acknowledge it. It's there as clearly a risk for markets. But we wanted to focus in on the data that we've had this week. And I think, George, one of the key things that we can take away from the data has certainly been this ongoing growth impulse that seems to be broadening out a little bit as well. And if we think about that maybe from the US, certainly we've seen over the past couple of weeks strength in employment, etc., feeding through into demand, and we got that at the start of the week with retail activity in the US.
Yeah, absolutely. So retail sales data was up 0.7% in March, so that was more than double what was expected to come through. And it's back to the point that the US consumer is in quite a resilient position. They're seeing low levels of unemployment. If they want a job, there's plenty of jobs available for them, and they can actually get wages which are growing above the rate of inflation at this point in time, which puts them in a strong position from a purchasing power perspective, and that in itself is part and parcel of the problem which the central bank have. At a time when they're trying to bring inflation back to the target, we're seeing this not just economic growth showing strength in one particular place. It was the service sector, but it's really started to broaden out across goods and also manufacturing as well.
And I suppose that, as you allude to, brings that bit of a conundrum really for the central bank. And one of the ways that I suppose it's evident to us is both the rhetoric that we hear in the dialogue from central bankers, but also just how markets have moved to price interest rate cuts. And if we look to where we were at the beginning of the year to where we are today, it's quite a contrast.
Yeah, material contrast. We came into the year, there was anywhere between 5 or 6 interest rate cuts priced into the US for this year. That's moderated. There's 1, maybe 2 at most expected now. And one of the big drivers which has really evolved that view in the last week even has been the comments from Jerome Powell, who made quite an important turn in terms of the narrative in which he gave around the pathway of interest rate policy in the United States.
And do you want to maybe bring that to life? Because really, if we look back to the October time of last year, it was very much about some of the rhetoric from Federal Reserve that allowed markets to really rally quite materially as changes to rate expectations came through. And then maybe a bit of a contrast to that now, a bit of a step back on that rhetoric from him.
Yeah, absolutely. So when you had more interest rates expected for this year was really when we were seeing the momentum in terms of inflation really starting to come down at quite a material rate. It was actually coming down to a point in where it looked as though that 2% target could be hit within around the summer of this year. But what we've seen is just the strength in services and shelter components, wage growth has really put some upward pressure on that, and it's slowed down the rate in which we're seeing inflation.
I suppose that's really about the ability to bring inflation back to their target, and this realisation maybe in their lens that we might not hit target inflation levels this year.
Exactly, and so Jerome Powell in the first quarter, he was quite constructive that even though inflation, the rate of change was slowing, they could still actually lower interest rates 3 times this year, and then same again in 2025 to eventually land them at around 3.5%. But he's made a pivot on that. His comments were much more cautious around their ability to do so, and recognising that there is a bit of a change in terms of the momentum in inflation.
And I think that's also a useful point to maybe pivot across to the UK to sort of pardon the pun there and think about the UK data where we had inflation and wage data this week that probably presented a similar challenge to the Bank of England in terms of their rate cutting expectation.
Yeah, so in the UK, so we actually had headline inflation which came in slightly lower than was expected, but the core inflation print, which excludes energy and food prices, which is actually slightly above what was expected. So in terms of the levels we're looking at now, you've got headline inflation at a 3.2% level on an annual basis, and then the core print is 4.2%. So that came down, but at the margin from 4.5%.
And probably within that, obviously, we could see what was happening from a services inflation level and an underlying wage inflation level when we got the employment report as well this week, which again provided a little bit of a challenge probably to the Bank of England.
Exactly. You can take the basket of inflationary aspects, and services is actually still growing at about 6%. So it's way above that 2% level which they need. So not all components within the inflation basket are trending towards the target, which is quite interesting when we think about the contrast of comments which were made by Jerome Powell in the United States this week, much more cautious around their ability to bring interest rates down this year, relative to what we heard from Andrew Bailey, who was quite upbeat. He was actually quite constructive that there is scope to bring interest rates and they wouldn't be determined by what was going on in the US.
Which I found quite fascinating to just think about that, because if we've got this quite significant divergence in policy expectation, there are other implications from a portfolio perspective when we think about that, particularly from a UK perspective, as to what that might mean for sterling and the inflationary impulse that we may see from weaker sterling as a result of that change in interest rate policy.
Exactly. I mean, one thing we have seen through the course of this week as a result of, the way in which the market is expecting interest rates to differ between the UK and the US is just the dollar to continue to push on there.
And just to maybe round that out with the euro, there was similar comments from various ECB members this week that they thought that they could move European interest rates independently of the direction of travel in the US as well.
Yeah, exactly. And it's it's the underlying components which the central bankers are really focusing on. Andrew Bailey in the UK was much more constructive that what we're seeing in the UK is not so much demand driven, which is what we're seeing over in the US. And some of that could be seen in the retail sales data, which was positive on a year-over-year basis. It was up around 0.8% to the end of March, but on a month-over-month basis, it
wasn't a lot of change. So despite the strength that we're seeing in the wage data, not really translating at this point into better retail activity in the UK. Well, thanks, George, for that. That was very useful today just to run through those key aspects. Thank you for joining us, and please do join us throughout the week for Morning Markets.